Market players yesterday and today. While many of the technical principles highlighted by Charles Dow are still applicable today, market conditions have changed and market players have evolved quite significantly. In the 1900s, there were three types of market players. Informed investors, who control 50% of the market. This group was made up of banks, corporations, and wealthy individuals who would buy and sell large quantities of market shares. They understood market conditions and economic data. They were the ones buying at the lowest price and selling at the highest price. Semi-informed investors, who controlled 40% of the market. This group was made of average investors and small businessmen who were somewhat informed with the state of the market, and they followed informed investors. They were the ones buying in the middle. After the price had gone up for some time, they would also buy. They were also the ones selling in the middle. After the price had partially declined, they would also sell. Uninformed investors, who controlled 10% of the market. This group was made of everyone else with a bit of extra cash to invest, but had little knowledge of what was going on in the market. They were always buying at the highest prices and selling at the lowest prices. Those same players were in the market up to the end of the 20th century. With the coming of the computer age and its fast-moving pace, the market has also evolved and 6 types of market players were born. Smart money, hedge funds, institutional banks, and prop trading firms. They accumulate and distribute large quantities of market share. They determine market sentiment. They buy at the lowest price and they sell at the highest price. Corporations and billionaires. They have access to the intricate mechanism of smart money. They invest, move large quantities of money, and therefore are able to buy at lower prices and sell at higher prices. Institutional and high-frequency traders. They follow smart money large orders. They buy or sell aggressively depending on what smart money does. They are the ones who cause exponential volume increase and drastic price movements in one direction or another. Their orders are automated, and their computers can send more than 50,000 orders per minute, whereas people can only send 1 or 2 orders per minute. Their trading activity lasts one day, in and out. Investment groups and small funds. This group is made of average investment companies who are somewhat informed about the state of the market. They listen to suggestions made by the big institutions and follow market trends. They are the one buying in the middle. After the price has gone up for some time, they also buy. They are the one who also sell in the middle. After the price has partially declined, they sell. Small investors and retail traders. This group is made up of online traders and small funds investors. They have the tendency to buy towards the end of the uptrend and to sell towards the end of the downtrend. Uninformed investors. Same as a century ago. This group is made of everyone else with a bit of extra cash to invest, who has little understanding of what is going on in the market. They base their decisions on emotional impulse, which very often leads them to buy at the highest prices and sell at the lowest prices. In today's market, there is a greater discrepancy between how much control each group has over price action. Investment groups and small funds, small investors and retail traders and informed investors control 20% of the market share. Smart money, corporations and billionaires, institutional traders and high-frequency traders control 80% of the market shares. In the following lessons, we are going to learn how to determine the dominating market direction, how to identify areas of support and resistance, and understanding why those areas are there in the first place. We will learn who is in control of price based on pattern formations appearing on the chart, where to enter and where to exit trades, and how to protect your profits.